Ma'am?
Can you talk about the CPF in Singapore?
Yeah, there was a lot of uncertainty, but back in the 90s, when the IRS had an office at the US Embassy here in Singapore, they put out like a paper that clarified everything. So removed the mystery from it. So essentially, so it's not deductible, first of all. So that much is clear. Not deductible from a US perspective. From Singapore, yeah, US, no. The employer contribution to the CPF, that is taxable to you from a US perspective. So you add that to your taxable income. And yes, it goes on the FinCEN 114, the F bars. So you do put it. And if you at the threshold where you trigger 8938 or the FATCA form, it goes there as well. The interest, so you get your annual statement from CPF, you just download it, December, and that goes in your Schedule B. So yeah, that's it.
Can you talk about CPF Life?
So that is after tax income?
So yes, so the growth is taxed. You get a credit for what you already pay taxes on, contribution. Would have trued up in the year of contribution. But the growth is taxed. So you'll do that. The other thing to keep in mind, where it gets really tricky, I mentioned earlier, there are rules where the U.S. wants to disincentivize people who have a U.S. tax residence from investing into foreign corporations. So the CFC, Controlled Foreign Corporation Rules, and PFIC rules, Passive Foreign Investment Companies. So the CPF itself, as Darren mentioned, there are revenue rulings. The IRS has come out and said that we're going to treat this like a business trust, basically. You're going to pay up on what the employer contributes as if it was like their salary and not deferred like it would be here. And then the growth is going to be income to you when you eventually take it out. But the complication is, what are they investing in the interim period? If it's like a cash where they're just paying you out, you're going to be okay. But if you start to do any investments, like into a fund or anything like that, those could be CFCs or PFICs. And now it not only is the growth going to be taxable, but it might be onerously taxed because you might have to throw back to when you originally acquired the foreign fund or the foreign investment that was negatively taxed from the U.S. perspective. So it's not just the CPF itself. It's what's going on below the CPF you got to be careful about.
What if my CPF is just cash?
As simple as it can get. Still not simple. It's not like an American pension fund, but it is the simplest it can get.
What if I leave Singapore and cash out the CPF?
It's the tax income, right?
Generally, the amount you've already paid on, so employer contributions trued up every year, you don't owe more tax on that. But the growth, that's a realization event. It's cashed out of CPF. Typically, while it sits in CPF and you wait for later, you're not having to pay on that growth. But once you leave and it's kind of cashed out to you, then if you roll it over into something else, there isn't a mechanism like there is in other parts of the code that allows you to roll over, like 401ks and IRAs and all that. There isn't such a thing for foreign pensions, particularly because there isn't a particular treaty in place here in Singapore. But even in treaty countries, sometimes there's not a rollover rule for foreign pensions that are written. So in essence, you're going to have to pay on the gain when that happens.
What if I move to a rollover country?
I'm not aware, we'd have to dig into it, but I'm not aware of anything that would retroactively. I think the rule is going to be about the CPF. There isn't a treaty to say you got to roll over. And so I don't think the rollover rule is you can go into a rollover from a non-rollover, but I'd have to check. We can talk afterwards, like I can check to get back to you if it's a simple answer. If not, it's a typical thing people ask me, how much do you charge? And I say $1,000 for 2 questions. What's your second question?
So on that theme, do you want to comment on the SRS as well? The supplemental returns,
right. Yeah. So those are, I don't think that's as absolutely decided. And SRS is really, that's a tricky one to the point that this gentleman was making before he left. So I do SRS for myself and my wife, but I understand I'm not really getting much because every penny I save in Singapore tax is just more tax I'm paying in the US. And they won't let me near anything resembling an investment. So I get like 0.05% interest every year on it. What I use it as is it's a nice little parkaway savings for the tax system here, which is incredibly awesome, incredibly easy, but The second you're no longer here, it all comes to bear. And so we got that SRS that's funded at least to the amount that you have on an annual carry forward basis. You know you've got something. You can just turn it over to the government rather than you have to go to cash sitting out there. And thinking was like a 12-month payment.
Was also the saving tax for SRS TV.
It's not taxed. So what you're putting into it is part of your income in the US. You're paying it. You're not getting get the break here in Singapore. So in essence, think of it like you got two buckets. This bucket says 38, that's the US. And this bucket says 21, and that's Singapore. And first you fill the 21, and then you got to top up to the 38. Well, once you make an SRL contribution, you reduce bucket 1 to 0, but you still got to fill the 38 in the US. So it doesn't really gain you much from the US.
22.
22.
Yeah.
So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle, the freedom, and even the tax savings you're looking for. Visit us at htj.tax and live that international life.